Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, I got a question from a viewer named Steve, and here's what we're going to look at. When you're in retirement, you're trying to create your retirement paycheck, you're trying to draw from your investments. The question Steve has is, which investments, which specific mutual funds or ETFs should you draw from first? There's a lot of videos out there, and I've created them, about which accounts to draw from first, between tax deferred, Roth, and taxable. But Steve's question is, once you figure that out, what if you've got 3 or 4 or 6 funds in the same account? How do you figure out which ones to draw from? Here's what he said. He said, let's say you have a 401k with a total stock mutual fund, a small cap fund, a Reit fund, and a bond fund, say divided 25% of your assets in each fund. Now, in retirement, how do you take out your 4%? Is it 1% from each fund? What if they were not all 25%? So you had different allocations in each fund. And, we're at different percentage amounts. How do you decide which one to deplete first? Further, what if you have a 401k and a traditional IRA, and now you have more than 4 funds? You might have 6 funds across those 2 accounts. How does that work when withdrawing your funds? Hopefully you can give us a hands-on video response. This is one question that no one seems to be able to tackle, so I hope you will try. Well, I've got my morning cup of coffee, and we'll give it a go. So I do think we need to think about 3 things: asset allocation, taxes, which we'll talk about in a minute in a taxable account, and then just ease of management. How can we kind of make this easy? Now, if we're talking about one retirement account, I think it's fairly straightforward. A couple of sort of caveats, though. We're going to assume you don't have an RMD yet. Obviously, if you have an RMD, you got to take out from your retirement accounts, although that still doesn't dictate which investments you choose from. So this would still apply even if you do have an RMD. But for our purposes, I'm going to assume no RMD for the moment. And here's the thing to keep in mind. If you rebalance your investments after you take your distribution, it doesn't matter which investment funds you take from. So we'll use Steve's example. Let's just assume you're going to take out $25,000 and you pull it all from the Reit fund. Remember, we had 4 investments in his hypothetical: total stock market, small cap, REITs, and bonds. So we'll just take it all out of REITs. So we take $25,000 out of REITs. Now, those funds may or may not have been 25% in each, even if that's our plan, because in our hypothetical, let's say we rebalanced a year ago and now we're taking out 25,000. Well, the actual percentages in each of those funds has likely changed, as some funds have performed better than others over the last year. But let's not even worry about that yet. Let's just assume we take all 25,000 out of the REIT and then we rebalance. Whatever's left, we say, okay, we want 25% in each fund. Or maybe it's a different percentage. Maybe it's 10% in REITs, 10% in small cap, 30% in bonds, and the rest in total U.S. stock market. That's fine. Whatever the percentages are, after we take our distribution from whichever fund we want, we then rebalance into the percentages that we have as part of our asset allocation plan, and you're done. It really doesn't matter which fund you take from if you rebalance after you take the distribution. So as a practical matter, what's going to happen is you're going to log into your account, you're going to sell enough shares in this hypothetical from your Reit fund to generate the income you need, let's say 25,000. And then it's going to take a day or two, a couple of days for that transaction to actually clear and you see it come out of your account. And then you could rebalance at that point back to whatever your asset allocation plan is. And that's really as simple as that. Now, what happens if you look at your accounts and they're kind of already in balance? Maybe the market hasn't been that crazy, and you look at it and you see they've all got roughly, in our hypothetical, 25%. I think as a practical matter, what you could do is, rather than taking from one fund and then rebalancing, you could just take an equal amount from each fund. Because that's effectively what you're going to do once you start to rebalance. You're going to be moving money around if you pull from just one fund to begin with. But if you're pretty much already rebalanced, or it's close to your plan already, you can take from each fund in the percent that you've allocated to that fund. Now, again, if it's 25% in 4 funds, you would just divide your 25,000 by 4 and take that amount from each fund. If you had different percentages, let's say you had 10% REITs, well, then you'd take, in our hypothetical, 10% of the 25,000 out of the REIT. If you had 10% allocated to small cap, you'd take 10% out of the small cap, and the same for each investment. If they were already pretty much already in balance, that might just be, as a practical matter, maybe an easier way to do it. But again, the end result is still the same. You take your money out and then you make sure everything is rebalanced. And the other practical consideration is this. Maybe you pull from the investments once a quarter, but you don't really plan to rebalance, say, but once a year. What I would do then, again, rebalancing isn't that hard, so one could argue maybe you should just rebalance quarterly if that's what you're going to do. But let's say you didn't want to do that. Then I would look at my investments and I would say which ones have performed the best, so that their allocation has moved above the plan. So maybe I'm going to have 50% in a total U.S. stock market, but it's done really well, and it's now at, 60%. I would probably take from the fund that had done the best quarterly, whatever fund that is, and it might vary from quarter to quarter, and then rebalance at the end of the year. The idea is it's at least bringing me back closer towards my investment plan. Now, I did find an article on the internet that sort of walks through this a little bit, and I'll show it to you here. It's actually from Schwab, and they actually have some hypotheticals that they go through, and I want to just show you this real quick. Here it is, and this is the idea that I've just described. Withdraw income and rebalance your portfolio all in one, and they give you some examples here. This is your sort of your plan, and you can see your allocations over here on the right. And then after a year, the allocations have changed as the market has changed, and some investments have done better than others. And then they walk through a plan where you're going to the cash out, what you're going to do to rebalance and get, in this case, they assumed a $40,000 distribution, and they show you the numbers. So I think this could be helpful to you, and I will leave a link to it below the video. One kind of way to approach it would be to add up your investments in your account. Let's just, to make the math easy, we'll assume you've got $1 million, and you figure out what your distribution is going to be. So if it's, again, we'll just say in this case, using Schwab's example, 40,000. So what you know then is after the distribution, you'll have $960,000 left. You have an asset allocation plan, I hope, so you can apply the percentages that you have for each fund to that $960,000. That will tell you how much you should have in each fund after you take your distribution. And then you can actually then compare that to what you've got and use that as sort of your yardstick to figure out which funds to take from and what rebalancing you need to do. Again, there's a number of different ways to do it, but the real key is take your distribution and then rebalance. Exactly which fund you take from doesn't matter, because the rebalancing will set everything back to where it should be. So often you're simply taking from the fund that frankly will make the rebalancing a little easier. Now, when we move into a taxable account, things get a little more tricky, because we have to think about taxes. Now, the first thing I would do is spend my dividends and interest from my taxable account. I would not reinvest them. I don't generally reinvest them anyway, not automatically, I should say. But in retirement, if I'm spending them, I'm not going to automatically reinvest them. So the first thing I'm going to do is spend any dividends and interest. But then which fund I'm going to take from after that is not just a function of asset allocation. I've got to think about taxes. And here there could be a couple considerations. For example, in some years, I might want to actually take from a fund that would trigger the most capital gains tax, long-term capital gains tax, because maybe I'm still in the 0% capital gains tax bracket. And so I actually want to fill up as much capital gains as I can in that 0% bracket. I maybe not want to go over that. And so that might be a consideration. I think probably for a lot of people, most of the time, you're wanting to actually keep your taxes to a minimum. And so each fund might have a different tax basis, and a sale of that fund, the percentage of the amount you sell. In some funds, more of it could be taxable depending on your tax basis. In other cases, less of it might be taxable. Your broker should be able to tell you that. You should be able to see the cost basis of each fund through your broker. I know it's true at Vanguard, at Schwab, at Fidelity. And so you can look at that tax basis and figure out what the tax consequences are going to be of selling, each fund, and then make a decision based on that. Here's kind of a next level strategy is if you have asset classes in your taxable account and you also have those in your retirement account or can buy them in your retirement account, one option is to sell the fund or funds in your taxable account based on tax considerations. And then after you've made your distributions, say for the year, step back and say, okay, now to get my overall asset allocation back to plan, rather than doing the rebalancing in the taxable account that could trigger more taxes, I'll go over to my retirement accounts and do the rebalancing there. So as a practical example, let's say in your taxable account for tax reasons, whether you're trying to avoid capital gains tax or maybe you're in the 0% tax bracket and you don't mind some capital gains, you sell a total U.S. stock market fund. But after you sell it for your distributions for the year and you step back, you realize that for your overall, all of your accounts, you actually need to buy some more total U.S. stock exposure. You do that in your retirement account, whether it's a Roth or a traditional. You can move money around from fund to fund there without triggering taxes. And so it takes a few more steps. And some of the analysis, if you're like me, might give you a bit of a headache. Put it down on paper, figure it out. Again, this is where the fewer overall funds you have to implement your investment strategy, the easier this gets. That's why I cringe when someone shows me a portfolio that some advisors created for them with 20 investments in it. Absolutely absurd and a complete nightmare when it comes to trying to generate a retirement paycheck. So those are the considerations that I go through in looking at all of this. Of course, in a taxable account, you also want to think about short-term capital gains versus long-term. You generally want to avoid short-term capital gains. That could affect potentially either which fund you sell or which shares of a fund or an ETF you sell. But again, in a taxable account, think of the tax considerations first. Make your sales, I think, based on that if you're selling in a taxable account. And then if you need to rebalance, try to do as much of your rebalancing as possible in the traditional or Roth retirement accounts. Now, the last thing Steve mentioned is what if you have multiple retirement accounts? Well, keep in mind, again, if you have RMDs, particularly if you have 401ks and IRAs, you got to satisfy that. But putting that aside, again, in retirement accounts, even if you have multiple retirement accounts and spouses, you might have each might have your own IRAs, you might have 401ks, you could have Roths. At that point, still, it's pretty easy because you can rebalance without tax consequences. So again, even if you have multiple retirement accounts, I think the strategy that I would follow would be the same as I described at the start of the video using the Schwab article, where you're taking a distribution and rebalancing at the same time. Again, you're rebalancing across your entire portfolio, but in a retirement account or multiple retirement accounts, it's tax-free. And so at that point, I think it's a pretty straightforward process. And the fact that you have multiple retirement accounts doesn't change anything in terms of the specific funds that you're going to draw from. So Steve, I hope this helps you. Hope it answers your question. It's at least how I think through this issue. Again, I'll leave a link to the Schwab article, which I think is pretty good. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. I'm going to get back to my coffee. So until next time, remember, the best thing money can buy is financial freedom.